Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, May 4th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I cannot give you financial advice. This is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, getting into this week's slide deck. U.S. Treasury struggling to sell all this new debt. Here's a tweet from Jesse Felder. A series of weak auctions for U.S. Treasuries are stoking investors' concerns that markets will struggle to absorb an incoming rush of government debt. Yeah, so we've talked about this in the past. You can see here, I kind of cut off accidentally the dates on the bottom, but long story short, this is the quarterly Treasury issuance, and it's just getting to the point where the Treasury is starting to have trouble getting the market to absorb it all. And we've actually seen rates creep up because of this. So I think that was part of Mr. Powell's discussions that he was saying, or statement this week, prior week. It was also probably the reason why the Fed decided they decided to slow down the runoff on the balance sheet, which in my mind, which basically means, they were reducing the balance sheet of their outstanding securities that they were holding by a certain rate, and they've decided now to slow that down. And the reason that is they hold those securities on their balance sheet. That's less supply into the market, right? It's not they're not having to sell those securities or let them run off, like they were before. So that, to my mind, is a type of easing. And so, look, I've said this before. I don't see anybody basically in the Senate or House that's really advocating for cutting spending. Maybe one or two people here and there, Rand Paul and maybe one of these backbenchers in the House. But, both presidential candidates are spendthrifts. Mr. Trump wants to spend money also. And so, the Treasury's having to sell all this debt. And part of the problem, it's not just for this current Fed, it's for Feds that go back even to Bernanke's time. They've enabled this. The bond vigilantes haven't been able to really exert themselves because the Federal Reserve has had this QE policy, and so basically the central bank is buying the securities and enabled all of this spending, enabled all this fiscal largesse, which has been inflationary. And again, it doesn't really matter, again, what I say, it's not going to change, but I think you have to understand that. And I think that I expect this to continue is what I'm saying. And so, they're going to try to jawbone things. They're going to try to play smoke and mirrors and follow the ball, the shell game. But in the end, this leads to monetization. If the debts just keep increasing, the interest expense keeps increasing, that goes on to the debt. It becomes this debt doom loop that I'm not saying we're in a debt doom loop, but we're getting very close to a point where we're going to, have to be borrowing money to pay the interest. I mean, that's like a lot of consumers out there, right? They have all this credit card debt. They pay the minimums, and they don't even own the underwear they're wearing. So, they're just in hock deep, and you can only do that for so long. At some point, you have to have austerity. At some point, as an individual or a business, you have to cut spending. And the same things with the government. They do have the ability to, especially if you issue your own currencies, print your own currency, and technically you can't go bankrupt, but you can lower the value of the currency and have inflation. So this is not good. I don't see, again, anybody on the horizon that's really going to stop this. I don't know when the last time that the government had a real budget. This thing's it's just further degeneration of the empire. This is what happens in late stage empire. They just spend more money than they take in. And I think it was even Marsha Blackburn, who's, I believe, a senator from Missouri, I mean, she said the other day, I think when she was being interviewed about this, basically these people, a lot of them know that this spending's unsustainable, but they realize that it's going to, before it blows up, or in their mind, at least when it blows up, they won't be there. And so the goal is to keep the game going, keep yourself elected, keep getting your privileges and, all the stuff that goes along with being a congressperson. And, it'll be somebody else's problem after you retire. You don't have to worry about it. So that's basically, I think, how a lot of people view it. And again, you can write letters, you can create Tea Party movements, you can get out the vote. It doesn't matter because whoever you vote in is going to continue these policies. You see that it's not going to stop. That's not being black pill, it's just being realistic. So I think you should look at things for the way they are, not necessarily the way you want them to be, and invest in quarterly and accordingly. Again, trying to point out, just reporting the news, not making a prediction, but the City Economic Surprise Index flips negative. This is the lowest reading in 15 months. Are we finally seeing now the slowdown in the economy? Possibly. Again, with rates being where they're at, and that does have an effect on consumers and in business. It has effects on the housing market, on the auto market for consumers, but that's being, I think, a lot of that drag that would normally happen to slow the economy down is being counteracted by the fiscal largesse from the federal government and these various free spending programs that they have. And I have a slide for that coming up. But are we finally seeing now the economy roll over? I think there's some signs out there. Again, this is from Tavi Costa, Crescat Capital. Times when the unemployment rate crossed above its 24-month moving average, which we've done. We've shown this chart before a couple months ago. But basically, when the unemployment rate crossed its 24-month moving average, this is when it's happened. And this is like during the GFC, during the pandemic, during the tech bust, S&L crisis, you get unemployment climbing when that happens. So remains to be seen if that's in fact what's going to happen this time. So here's a discussion that was from a Fred Hickey tweet. I just want to read some of this. This is pretty interesting because it kind of explains what happened last week. It said Fed holds rates steady in order to combat stubborn inflation, but then slashes QT. I just said that, slowing down the runoff on the balance sheet. QT pace, and Powell states that the Fed's next move will not likely be a rate hike, which leads to a bond market rally that eases financial conditions and encourages more inflation. So they're trying these little bag of tricks, jaw-boning things, slowing down the amount of QT, hoping that against hope that works, that inflation will drop to the 2% target, which in my mind is arbitrary, but regardless, hoping it drops to that 2% so they can do what they want to do anyways, which is cut rates. Tweet goes on. Also, didn't the Fed apologists claim that QE wasn't really money printing because it was temporary? Looks like we'll have $7 trillion on the Fed's balance sheet until they ratchet it up again to combat the next crisis. There goes that argument. Then he quotes Bernanke from 2009 when they started this QE thing. And I find this interesting. This is why you have to watch what people do and not what they say. This is Bernanke back in 2009 talking about quantitative easing. But clearly, this is a temporary measure which is intended to provide support for the economy in this extraordinary period of crisis. And when the economy is back on the road to recovery, we will no longer need to have those measures, unquote. Well, we have the balance sheet now above close to like $8 trillion, between $7 and $8 trillion. They're slowing the quantitative tightening. And so, I go back to like what Felix Zulauf said, that he could see a scenario where, the Fed's balance sheet is 30 or 40 trillion dollars, in the next decade. And that makes sense because the CBO itself is projecting the total debt to be $50 trillion. So I don't think the bond market and savers are going to be able to absorb that amount of new debt issuance. And so I think ultimately there will be quantitative easing. The central bank will have to be in there buying these bonds. One last comment from Fred Hickey. Real reason Fed is slashing QT, like we've talked about. Treasury Department is having trouble, poor auctions, funding U.S. government's out-of-control spending binge. Fed's QE money printing has been enabling the government's irresponsible spending all along. That's what I said, like in the opening comment when I showed the Jesse Felder tweet. The fact of the matter is that if the Federal Reserve had not been buying these securities, then rates would have went higher a long time ago and forced the federal government to slow its spending down. The bond vigilantes would have been able to exert their pressure by raising market rates. But with the Fed stepping in during the housing crisis and subsequent to that, with these quantitative easing programs where they're just buying these securities, that's how they were able to get rates down to zero. So, they were just buying basically, I think it was upwards at one point 100 or 150 billion dollars a month in mortgage-backed securities and Treasury securities. So there was no way for the market to exert pressure by saying, "Hey, wait a minute, you're issuing all this debt, government. This starting to look unsustainable. We want a higher rate of interest to compensate us for the risk that you are not going to pay this back." And that would have, that's why Bill Clinton made that statement back when he was in office that he joked if he died and was reincarnated, he'd like to come back as the bond market, because the bond market during his administration, there was no QE. It was exerting pressure. Rates were going up, and it was exerting pressure on the federal government, and it wasn't allowing it to expand its debt to the point that they wanted to do these various programs. So we basically, have this system again that's kind of debt-based. It's reliant now on this QE. People warned about that many years ago, and of course, people poo-pooed it. You saw the Bernanke quote. It was supposed to be temporary. None of these things are temporary. No taxes are ever temporary. It's just the way it is. And so this is late stage empire stuff. Spending more money you take in, lack of virtue among the leadership, looking out for yourself. It'll be somebody else's problem. I'm not, even though I know it's a problem, I'm not going to have to deal with it. I saw this great quote that I'm using a lot now because I thought it was so great. It was Robert Louis Stevenson. I don't know what writing it came from, but I remember the quote is very, very good. It's something around the effect, I'm paraphrasing. Eventually, everyone sits down to a banquet of consequences. And so I think that even applies to states, right, or to governments. Eventually, again, I said this, Steve Barton in It to Win It interviewed me, and we kind of went down this rabbit hole, which a lot of people don't like talking about because they're like, well, give me that hot stock that's going to go up. They don't want to talk about these type of things. But it was basically, we don't have a virtuous society. We have this so-called democracy. And if you really want to get into it, there's a Fred Reed recent column that he wrote about democracy and one man, one vote, and what that really means, and how, basically how ill-equipped most people are to be voting because they really don't know anything. So those are other rabbit holes you can go down. But long story short, they're not going to reverse this. They're not going to quit spending. And so all roads, in my mind, lead to additional currency devaluation via the printing press. Now, that doesn't mean you rush out Monday morning and gold starts going up. This is a process, but that's your general direction going forward, probably punctuated with times of, where the market, pulls back or interest rates come down for a while. But I think rates are going higher. The Fed's going to have to step in. There's eventually going to be yield curve control. There's eventually going to be further down the road, there'll eventually be capital controls. There's going to be all kinds of things, because they're going to go back to the bag. Instead of just doing what you should do, which is not spend more money than you take in, they can't help themselves, because that's how they stay in power, by dishing out favors and money to different constituencies. Instead of getting up there and showing real leadership and saying, we can't afford this, therefore we can't spend the money. That's never going to happen, right? You won't be elected like that. So we have this little phony game. It will continue till it can't continue any longer. But I think that's what you can count on going forward. I don't know the exact timeline of when these various things will be implemented, but they'll implement them. They have no choice. Again, both presidential candidates that are running for president, they're not advocating any kind of fiscal restraint. I don't hear they all want to spend more money. And then we're in World War III now. So we have to get our defenses up more. We have to build our defenses. We have to spend more money on defense. We have to spend more money. We have to expand coverage for various programs. We have to do all of these things, and yet the American Society of Civil Engineers rates our infrastructure as D. In many cases, we have, all the problems. I'm not going to go through the litany. And so we have plenty of money for everything except for the things that are needed. And we just, this is just a big game for an oligarchy to feed at the trough and reward people that are, as we talked about in the article about the Cantillon effect, those closest to the king are the ones that get first dibs on the largesse. So here we go. This is 5.5 trillion of fiscal spending on this. This is on the left here. This is the Marshall Plan versus COVID response. U.S. fiscal spending as a percent of GDP, 19% for the COVID response, which is around $5.5 trillion of fiscal spending. It's not all been spent, by the way. This so-called Inflation Reduction Act and this CHIPS Act, and this money really hasn't even fully made to the economy. But you contrast this with the Marshall Plan, which was the spending that was done after World War II to help rebuild Western Europe as we were entering the Cold War and trying to parry the advances of the Soviet Union in Europe. We only spent 5.4% of GDP, yet we're spending 19% on because we had a bad flu season. So anyway, it is what it is. This is, I think, the main reason why, even with rates up like they are from basically 0 to 5.25 on the Fed funds rate, this is why you haven't really seen the economy tip into recession, because you've had this spending that's kind of propped things up. So this leads to, in my mind, again, to that Cantillon effect, that bifurcation, economic bifurcation of America that I call it, the haves and the have-nots, those that get what's going on, those who are asset holders, those who have wealth benefit. I mean, 5.25%, you can, if you have any savings, you should be getting, you should be in a money market fund getting that. So that's a benefit to you. I mean, most working people don't have any savings, right? They live hand to mouth, paycheck to paycheck, probably half the population or more. And so this is another Jesse Felder tweet, says, there are two Americas in 2024, the one for people with jobs, homes, and stock portfolios, and the one for everyone else. So you can see the chart down here. It says rich get richer. The household wealth boom has helped baby boomers the most. This is basically delineated by net wealth of the silent generation, which is, your pre-World War II people, and baby boomers, and then Gen X, of which I'm in, and then the millennials. And so as these people die off, this wealth will be transferred, but you see a lot of the baby boomers are spending their wealth, right? You've seen those stupid land whale RVs and a sticker on the back. I've seen several of them. I'm not making a generalization, just pointing out anecdotally. It basically says we're spending our children's inheritance, that type of stuff. So anyways, basically, if you have assets, you are participating in this Cantillon effect, because as the money printing happens, as the fiscal insertions in the economy, you have the ability to benefit because the assets that you hold will increase in value. Even if you're sitting in a money market fund now, a couple of years ago, you were getting 0% basically, or 0.1 or 0.2%. Now you're getting 5.25 and risk-free. And so again, goes back to the adage of the rich get richer and the poor get poor. This is why I tell a lot of young people, don't sit there and cry and whine. Get a bankroll together. You have to participate. this bifurcation is going to continue until it can't continue any longer. I think at some point it will cause social, political, and economic um, uh, eruptions or earthquakes, but I don't know if that's going to happen this year, next year, or 5 or 10 years. In the meantime, the Cantillon effect rules, and when money's created, if you hold assets, you will do well. If you're living hand to mouth, you gotta look at what you're doing. I mean, most of the people I know from the demographics, from the stats, that people that listen to this podcast or these videos are typically younger men, in their early 20s up to their early 30s, and you guys are getting started in your careers. If you're getting capital together, instead of sitting around goofing off on weekends at Buffalo Wild Wings, farting on your buddies watching, sports or whatever you're doing, you got to get a side gig, and you got to get a grub stake together. You got to participate in this, or you're going to lose ground. And you really have to pay attention to what's going on, because you can't afford to be making stupid mistakes, which I'm going to get into an example of that later on in this discussion this week. Got a slide coming up that kind of highlights that. So consumers are struggling, right? Here's a tweet from QE Infinity. This came out. This was big news this week during the earnings reports. McDonald's and Starbucks both missed earnings today. Two of the most consumer sensitive stocks we have. What's that they say about the state of the economy? Just let that sink in. So basically, I think I heard another commentator point this out, which I thought was a good observation. You have Starbucks, which is kind of like the trendy upper middle class, wealthier people that are willing to pay $6 for a cup of sweet coffee. You have that's where sales were down quite a bit there. But then also McDonald's, even with value menus, it's more of your lower middle class, working class, lower class people going there. And I think I also saw the same thing, like Walmart sales. So we've got both spectrums of the consumer is struggling. And so I think a lot of this is because of inflation. The price of things is just getting out of control. I think I don't know. I think I don't really go to fast food restaurants that much. I do like to go to Chick-fil-A once in a while, and I'll typically get a club combo, large size with an unsweet lemonade, and then a 12-piece nuggets, just the nuggets. And I think the last time I did that, it was like $25. That's crazy. I think the last time I went to Chipotle, I usually get a double bean, double protein, like chicken or steak, and that's like over $20 now. So $20 for basically a burrito. That's kind of crazy. I think the last time I went there. So I can pay it. I just makes me raise my eyebrow. But what does that do for the average, wage earner out there, average wage slave? It's hard, it's going to affect sales. At some point, the prices get high enough where, I'd say even when I was in the grocery store the other day, I kind of look at the, meats and stuff. I get my meat somewhere else, but they're kind of like shaving these steaks down. I saw some New York strips that were like 3/8 of an inch thick. I was like, the butcher was out there, or the stock person that with the meat, looked like a butcher. I go, how much thinner can you slice these things? Pretty soon you can see through it, And he just said, he just shrugged his shoulders. He said, hey, people can't afford it. So we gotta, we got to do what we got to do. If we put the cuts we used to put out there, they would be like way up there. So anyway, you can sit here and point out these anecdotal examples. Everybody's feeling it. And so if your wages aren't keeping up, if you're a working person, a wage slave, I don't know how people are making it. And so I think we're starting to see the effects of that bleed through in the economy. But again, if you're in the upper middle class or a wealthy person, it doesn't really, you kind of just, you don't like it, but if you have enough money, you can pay. So you just keep doing. So that's why you have this bifurcated two-tier economy. So this is interesting. So, this is part of the story of moving on with the change in the zeitgeist, the change in the view towards nuclear power. Here's a tweet from Mark Nelson, guy I follow on X. He's a nuclear guy, nuclear power guy, not necessarily a uranium investment guy, but nuclear power. And his tweet is, Energy Minister, Italy to return to nuclear energy. Italy is one of the only countries in the world to have exited nuclear. Now, just after Germany turned off its plants, Rome lays out a goal of returning soon. A referendum following Chernobyl in 1986 closed Italy's plants. So again, this single event doesn't really do anything by itself, but again, it's part of the you know, many events that are pointing to the same conclusion, that nuclear is going to be, barring some major catastrophe that, interrupts its development, i.e. another nuclear disaster, it's onwards and upwards. People have gotten it. It's just amazing. Again, when I was getting interviewed by Steve Barton, I pointed this out. He asked me what I was most bullish on, and the most bullish thing that I'm long term that I'm bullish on is uranium. I mean, it's just so amazing how it went from being hated just several years ago to it's the solution now, and that's great. And I think that really gives you a long-term runway of supply or demand growth, right? Because people investing in all these new SMRs and people building all these reactors in all these countries. I think it's really great. But again, where does the supply of uranium come from? There's no substitute. Yes, some wag will now enter the comment section and say, what about thorium? What about it? Everybody's building uranium fueled reactors. Yes, at some point, we'll probably use thorium. It's not like in the next year or two. So, I think that from a supply demand, from a perspective, economic perspective and business prospectivity, uranium and nuclear power really, in the resource sector at least, is probably still has the most upside in my view. Again, it just requires patience. It requires, buying when sediment is low, when it's blown out. After, you don't buy. What happens is people just keep buying after the big runs, and it's like you have this embers blow on this campfire and come along and blow on them and get this blaze going again, then everybody's attracted to it, and then as it dies down, you can't make any money in this. Or I've seen so many tweets, I've said this before, so many, whatever they call them, I still call them tweets, or people that were really all these uranium accounts, uranium sucks, blah, blah, blah. Yeah, because it's down. It's not doing what you want it to do this week. But again, I've pointed out the charts going back 3, 4, 5 years. If you were a buyer 3 or 4 or 5 years ago and you've held, I mean, you should be really doing well at this point. And so I continue to hold. I continue to find things I think that I want to buy when they go on sale. And I don't see anything changing my view unless, again, we have a nuclear disaster. So this happened last week too. The Senate passes the ban on Russian uranium. I don't know. The House passed it already last year, like November, December. Now it's waiting for Biden to sign it. I don't know. This kind of reminds me of uranium or the Section 232. That was going to change everything. I mean, this thing has holes in it that if you can't get any uranium besides Russian, you can get dispensation on a case-by-case basis. So I don't think that this is just another attempt to punish the Russians because of what the mob doesn't like what happened, what is happening in Ukraine. It didn't work in the oil market. The oil price suppression scheme that was cooked up by all the pointy issues didn't do anything. These are fungible commodities that are in demand. Somebody will buy them. We have a shortage of uranium in the world. It's not like no one's going to buy Russian uranium. So they'll, and so eventually, I think you'll quietly see down the road dispensations being given if they can't. I mean, we don't have a uranium industry in the USA. Where is this uranium going to come from? It can be created. It will take years and billions of dollars, which I'm fine with, but this isn't really going to do anything overall for the market, except maybe slightly on sentiment. I don't know. We'll have to see. There's usually unintended consequences for these things that you can't normally see when they're implemented. They usually manifest later on, and nobody goes, "Oh, gee, I never thought that would happen." I'm not a big fan of governments intervening in markets. It usually doesn't work out very well. I understand that some people think this is the morally correct thing to do. Well, we can differ on that view, but typically, when governments insert themselves into markets, they usually create dislocations that causes price volatility and allows for speculators like myself and others to take advantage. But here's the news. The U.S. Senate approved on Tuesday legislation to bar imports of Russian uranium as the United States continues to seek to disrupt Russia's efforts in its war against Ukraine. The Senate passed the measure by unanimous consent, meaning that no senators objected to it. The House of Representatives passed the bill in December. The legislation would ban the import 90 days after enactment. That's after Biden signs it. It contains waivers in case there were supply concerns for domestic reactors. I think this next part is really what's beneficial for the industry here in the US. It says the bill also frees up $2.7 billion passed in previous legislation to build out the domestic uranium processing industry. Well, we'll have to see what that means. I don't know exactly what that means. Again, government's not necessarily the best allocator of capital. But you can do something like, okay, domestic producers will buy your uranium at like spot plus a certain price, and that would stimulate demand because it would give certainty for the industry that it could get it above market, and that would draw capital. You could do something like that. I don't know what they're planning on doing. Again, this thing's going regardless of this legislation. This uranium price is moving higher over time. And so, again, probably going to cause some unintended consequence that we can't see right now that will likely lead to an ability to for a speculator to take advantage. So world is poised on the edge of a new copper super cycle. This is in the Telegraph. It's nothing that we haven't talked about. The reason I wanted to put it on here is because this stuff's going more and more mainstream. And as it goes more and more mainstream, as the story, as Don Cox used to say, moves from page 16, where nobody sees it, to page 1. And so we're already positioned when this thing was on page 16 or page 20. And now, as the story moves to page 1, that's when large capital will come in. I always consider the Actionable Intelligence Alert newsletter to be the smart money. In a cycle, what typically happens is the smart money comes in first. People that can see over the horizon, can see the potential, can see the inflection that's happening in a certain industry or company. And then what happens after that is, that's a small group of people, not a huge amount of capital. And then the waiting game happens. And then as this thing starts to inflect, and starts to play out as the early adopters or the smart money, as we had foreseen, then we get into the institutional phase, when institutional money, and that's when this happens, when it starts getting into the press, when analysts start following it, when they start directing, people to, hey, you might want to put some money into these copper stocks, you might want to put some money into this uranium business or what have you. So I think this is I put this up. I'm not going to read the article. I'll put a link to it in the show notes. It's just part of the article, but this, it's a major newspaper, the Telegraph. So when talking about the copper super cycle, says key growth sectors have an insatiable appetite for the conductive metal. Also, the fact that supply is just being constricted. So it's the same story that we've talked about in many other resource sectors, many other commodities. Again, unless the government gets involved and screws it up, which a lot of governments are screwing things up, shutting down that huge mine in Panama, trying to squeeze these various companies like Chile, playing around down with Anglo American, things like that, are not conducive. Plus the fact that the easy copper in a lot of the better jurisdictions has already been found and being mined. And so now you have to go into these whacked out areas like, the DRC and these other places where, you don't have the stability sometimes that you have in other jurisdictions. So it's going to make it more expensive is what I'm saying. So if you already own companies that already have good assets and could take advantage of the price rise, then you stand to benefit. This is an example right here. I own Glencore. I just think that they're a tremendous management over there. They really get it. I put this, nobody else dubbed them this. I dubbed them the king of coal. We've seen just about every major mining company divest their coal assets. And one of the companies that's been there picking up the assets has been Glencore. And so I think I see what they see, or I think I know what they see, which is coal's not going away, especially in the emerging markets and the developing markets, just because of the fact that as these people, as these economies, as they get wealthier, as they enter a certain level of per capita GDP in these countries, in the emerging markets, their demand for energy inputs into their economy, copper, all kinds of things starts going up through basically an S curve. If you don't understand, then just look at what happened with China and the growth of commodity demand there, and then extrapolate that across the other 3.5 billion people between Istanbul and Jakarta, and that are now going through something similar, and then add another billion people in Africa that are bringing up the rear. And the reason why coal is so useful is because you can build a coal plant fairly quickly. The fuel is coal's very readily available. It's transportable. You can handle it fairly easily and safely. It can be stored, as long as it's stored properly. It has to be certain things have to be done when you build a coal pile, but that's a whole nother story. It can be stored for relatively long periods of time, and that's why people use it, and that's why it's not going to go away. I do think 25, 50, 100 years, nuclear will be the main source of electrical generation. But coal's not going away, and I think Glencore gets that. And as these other mining companies have divested their coal assets, Glencore has been there buying a lot of this. And so this was a Bloomberg article. I want to read a couple things out of it. It says, coal has become an increasingly dirty word in mining, with more and more investors calling for its demise. Yet, when push comes to shove, some are reluctant to say goodbye. During the past 5 years, nearly every major miner has either quit coal or set out a path to its exit because of pressure from shareholders who don't want to own the most polluting fuel. The one company that resisted this push was Glencore, the world's biggest shipper of the fuel. And so it goes on to say that even Glencore, when they were buying the Teck mining, divested their metallurgical coal assets, and Glencore bought them, I believe. And then the board at Glencore was talking about splitting the company into two entities, one of which would be copper and those type of metals, the new energy metals, as is fashionably called in the Western press, and then it's coal business, and splitting these things off. But then the major shareholders of the company came back and said, no, we don't want you to do that. And the reason why is because there are times, coal's a good business most of the time, just because of what we talked about before. You're not going to build a lot of new coal mines. The demand's there, but supply is kind of constricted because of just what we talked about, ESG, and people don't want to be associated with it, blah, blah, blah. But a lot of the major shareholders, and they're listed in the article, I didn't put that on here, but they basically came back to the board and said, no, this is a cash cow, keep it. We want this kept intact. And so this is the last blur kind of alludes to that. Says, as a high volume business, it becomes an absolute cash cow when prices rise. Glencore made a staggering $8.6 billion from its coal mines in 2022 as the global energy crisis sent the market skyrocketing. So the point is that don't sleep on coal. It's not going away. It may be going away in the West. Obviously, the EPA is coming up with even more stringent emission standards in the U.S. but we see the failure of the renewable push in places like Germany, which is resulting in more coal burn. Focus on, excuse me, focus on the emerging markets in the developing world. That's really where coal is seeing growth, and it's going to continue to be used for, I would say, decades. And that's why I think Glencore is worth looking at. That's why I call it the king of coal. So wanted to point this out. We had a nice run in gold. Gold's broken out. It's going higher in my view over time. It's pulling back recently, but this is something we've talked about. In 22 and 23, central banks were the main drivers of gold demand, not retail investors in the West. Mostly emerging market, developing market central banks. Why? To supplement their reserves away from dollars towards something else, and gold has historically been used as that. I wanted to point this out, that the central bank gold buying continues in 2024. This is what I was wondering about or concerned about. Would this carry through for a third year? And we see through the first quarter that a record 290 tons of gold, that's a new first quarter record, has been bought by central banks. So the trend continues, it seems. Central banks are leading the way. I think that, the gold price technically got overbought. It's probably going to pull back. But again, I think that we still haven't seen, as I've pointed out before, we've seen a lot of central banks, probably most central banks now around the world, are cutting rates, increasing liquidity. We just haven't seen the bazookas come out yet, right? The central banks of the ECB and the United States, and to a lesser extent, the Bank of England and the Bank of Canada. So these will all be cutting rates at some point. We'll have a global synchronized rate cutting cycle. And I think that's an environment for much higher gold prices. Again, the Western economies are just all in this basically the same boat to various degrees. Too much debt, don't have their spending under control, getting themselves into this World War III situation where they're going to have to increase spending. Wars are inflationary. And so I just feel like, nothing, gold has finally broken out. I just see a lot of wind in the sails going forward. Again, that doesn't mean it goes straight up week after week. You have pullbacks, but I think that that is going to be a place that I think is going to surprise people over the next couple of years. And again, we go back to this, pointing this out again from Crescat Capital, gold versus small cap explorers. This is basically spot gold in yellow. And this is the TSXV. A lot of the TSX has a lot of junior mining companies, and they really haven't moved yet, right? And why would they? I mean, who's buying gold? Central banks. Central banks don't buy mining shares. But I think if the gold price, after this pullback and, kind of goes through this technical move from being overbought, and it moves higher, then it's eventually going to draw more and more capital, I think, into the mining sector. We've already seen some of the majors and intermediates start to move, and eventually that trickles down into the junior sector at some point. But I think that's yet to come. So this is what I wanted to talk about. Speculation is alive and well. So I saw this tweet. I don't want to pick on this person. I don't know who this person is. I don't want to harass this person, but this is what I hate to see. This is what I wanted to talk about. It says, he writes a tweet. Okay, fellas, be honest. How risky is it to take one of those 0 APR cash advances on credit cards to buy some crypto? I'm thinking 20K. It's literally a blank check with 0 APR for 12 months. I don't see how we fail here. So again, Charlie Munger passed away, but I have a lot of his quips memorized. A lot of people find it entertaining. I find them pertinent and useful. One of them was avoid 3 things: to, not get yourself in financial trouble. Those being liquor, ladies, and leverage. No, I don't think it's a good idea, Ashen, at Noda Ashenon, to use credit cards to buy crypto. Cryptocurrencies are very volatile. I don't know if you're talking about buying Bitcoin or some other coins that, some of these crap coins. I don't know what you're talking about doing. I don't think you should even use leverage for stocks. The average person shouldn't. And because what happens is the fact that the volatility will knock these people out. I mean, if something drops, they go and borrow this money and then something drops 50% or more, then what do they do? You're still on the hook for the debt. And then what are you going to do? You're just going to hold it till it comes back? Well, I can tell you from personal experience, when something drops massively, it typically doesn't come back. Now, very well that this could work out. There's a lot of people on X and other places that say that Bitcoin is going to do nothing but go up over time. At some point, it'll be $1 million Bitcoin. I guess in that environment, you would do well. But you don't know what's going to happen in the future. I don't know what's going to happen. And things never really happen the way we want them to or think they will all the time. And so what if it takes, 5 years? Or what if something happens and then you're on the hook? Maybe it's only 20K, but it sounds like this is some money for this person. So I wouldn't recommend you do this. This also tells me that there's a lot of speculation in the market and that the Fed should probably keep raising rates. You got to drive this type of speculation out of the markets, but they're not going to do that. And that's why we have people like this person, unfortunately, that ask questions like this. So I don't think this is a good idea. I've learned my lesson early on in my career. I used leverage. It blew me up after 2008. I probably should be a lot wealthier than I am now. But I used a lot of leverage and it went against me and I didn't act well. It didn't bankrupt me, but it set me back. And so, no, I don't recommend you use leverage for anything if you don't have to, especially in investing, because then you're kind of speculating. You're kind of hoping that the price goes up. You need something to happen. And if it doesn't happen, then are you psychologically equipped to deal with it? Most people aren't. And then you get this situation where you're stuck with this asset and you're sitting there, laying awake at night, staring at your ceiling with your stomach turning, and you still have to pay this debt back, even though it doesn't have an interest rate, and the asset you bought is down, then that's not a good place to be. So no, I wouldn't do this. Okay, that's it for this week, guys. Appreciate the viewership. Again, the channel continues to grow. Please like and share the channel. If you want some more information, I do have that free weekly email on Substack. You can sign up in the show notes. I think it's a pinned comment down below also. It's a free email I put out every week. It has a lot of good further information, podcasts I see, or good articles that I found, things that are pertinent to what we're talking about. But then again, or from that, typically people migrate eventually to the Actionable Intelligence Alert newsletter. That's where the smart money crowd goes. That's what I'm talking about, the smart money, where we try to get ahead of the trends. We try to get positioned before everybody else figures stuff out. And then, we're shooting for 3, 5, 10x returns there over a period of time, obviously, not in the next week or two. But that's kind of what that's set up for. I also added in the portfolio a dividend portfolio. A lot of people had asked for that in the Discord channel. That's another benefit of the paid subscription, is access to our Discord channel where a lot of great conversations go on. So those are different ways you can support the channel. You can also buy me a coffee and other things that you see in the show notes. We appreciate all the support. This is reader and listener supported. All right, guys, that's it for this week. We'll talk to you next week.